Last lesson, we talked about what valuation is and why it's important. Today, we're going to be rolling up our sleeves and actually figuring out how investors and founders value companies. We're covering the top 7 valuation methods for early-stage startups. An overview. First, we'll be talking about pre-revenue valuation methods. These are most applicable to early-stage startups, and they include the Berkus Method, the Scorecard Method, the Risk Factor Summation Method, and the Venture Capital Method. After that, we'll then move on to post-revenue valuation methods. These include discounted cash flow, or DCF, comparables, or market comps, and the first Chicago method. Finally, we'll talk about how to put them all together using the football field valuation approach, and we'll discuss crowdfunding valuations and how that's applicable for crowdfunding investors. Now, as we show them and present them, this is generally going to be in order of increasing complexity. So the Berkus, Scorecard, Risk Factor, and VC methods are the most simple, and then it gets more complex as you get into post-revenue methods. Just a reminder, we discussed this last lesson, but this is the valuation versus traction matrix from Jason Calacanis. It shows how, on average, a startup will go up in valuation as they gain additional traction. However, there are various factors, such as famous founders, the type of accelerator that they went to, or many other things, which can either cause them to have a higher valuation than on average for a certain type of traction, or lower than average. Valuation is an interesting thing. It may feel like a tug of war, where on one side you have the founder, who's trying to get the highest valuation possible so that they have the lowest dilution. But on the other end are the investors. They're pulling for a much lower valuation, where that typically corresponds to greater potential investment returns. Now, founders are also going to be more rooted on future expectations. They will focus the conversation on the future potential cash flows and the future potential impact of their business, since that can drive a higher potential valuation. Whereas investors will want to be more rooted in the present. They'll try looking at current metrics and value, still keeping the future in mind, but trying to bring the founder back to reality to get a more reasonable valuation. In reality, the valuation typically lies somewhere in between the two extremes of the founder and investors, and that's where negotiating comes in for angels. However, for crowdfunding investors, the valuations will already be determined in advance as it's posted on the portal. Thus, there won't be any negotiating, and you'll either have to make a decision that you will invest or you won't invest based on the valuation that's presented. Also, just a reminder, there's no substitute for experience. All the valuation methods we're talking about today are guidelines. They all are sensitive to the inputs and the assumptions, and a more skilled user of these tools will have better outcomes. Over a decade ago, when I took some college courses, I had one professor who always used the saying, garbage in, garbage out. That is to say, you could have the greatest formula for something in the world, but if you put garbage inputs in, all that formula is going to spit out is garbage. In a similar way, these are all tools to be used and depend very much on those inputs. Most of these methods do depend on starting with an average pre-money valuation for a group of similar startups, whether that's representative in a region or a sector, etc. Thus, that starting group and the representative valuations is going to be very important in terms of what these methods result in. All of this depends on things like market dynamics, supply versus demand, and more. So, my number one suggestion for crowdfunding investors, based on my own approach, is to always try to estimate valuations while doing your research before looking at the offered valuation on the crowdfunding portal. This can be hard to do since it's typically posted pretty obviously near the top, but by doing this, it avoids price anchoring and other biases, and I think it's one of the best ways to see where there's disconnects between your own thinking and between reality. That's why the best way to get good evaluation is to just look at lots of companies and to gain that practical experience. One last point before getting into the actual methods today. Peter Thiel had some very good charts and discussions on future cash flows in his book 0 to 1. He said, simply stated, the value of a business today is the sum of all the money it will make in the future. That makes sense. Thus, he says, most of the value of low-growth businesses is in the near term. Technology companies follow the opposite trajectory. They often lose money for the first few years. It takes time to build valuable things, and that means delayed revenue. most of a tech company's value will come at least 10 to 15 years in the future. If you look at what this might look like depicted in a graph, here's those two different types of businesses. On the top, you have the present value cash flows of a business that's in decline. You can see year over year, it's going down. Whereas in the bottom chart, more representative of a tech company, you see that it takes many years to ramp up growth, but then potentially it starts declining at some point in the future. Thus, when valuing these top businesses, you're going to see that most of the cash flows are in the present, and that's why they're valued based on present metrics. Whereas tech companies, you have to look more in the future. You can't value it based on present metrics when most of the revenues are going to be coming in the future. That's why it's a little tricky to value pre-revenue early stage startups. So, let's get into it. What are the tools and methods that investors and founders can use to estimate the valuation of early stage startups? Pre-revenue valuation methods. First, there's the Berkus Method. This was devised by angel and VC investor Dave Berkus, originally in the mid-1990s. He's updated it a few times since, but he basically says it was created specifically for the earliest stage investments as a way to find a starting point without relying upon the founder's financial forecasts. Now, the numbers in each category have to be adjusted based on the current market, geography, industry, supply versus demand, and other relevant factors. For example, while the traditional Berkus method assigns $500,000 for each category, which results in a $2.5 million maximum possible valuation for the startup, it could also be $1.5 million in each category, resulting in a $7.5 million maximum valuation. Perhaps this would be more representative of, for example, a Silicon Valley startup. So, what does this look like? The 5 characteristics of the Berkus method are sound idea, basic value, a quality management team, reducing execution risk, prototype, reducing technical risk, strategic relationships, reducing market risk, and lastly, product rollout or sales, reducing production risk. As we mentioned, the way this works is that each of these gets assigned a value up to $500,000 in the traditional Berkus method, which would result in a total startup value of up to $2.5 million. However, as we mentioned, just adjust this. So if a more representative startup value for the companies you're looking at is, say, $5 million, then do 5 million divided by 5, and each of these areas would have 1 million as a possible maximum. Basically, you start with 0, you sum up all 5 areas, and that's the valuation that this method results in. So, what are some pros of this? This is one of the quickest and highest level valuation methods, and it doesn't rely on forecast. Because of that, though, there's some potential downsides. First, it weighs all 5 areas the same in terms of importance. It doesn't say give the team more importance than the product, or other things like that. Also, it requires skill to know how much to credit in each area. It ignores some areas that more detailed methods covered, and it's dependent on choosing an appropriate benchmark startup valuation to start. For example, whether that 2.5 million max is more representative, or if it's a 5 million or 7.5 million or whatever it is. All right, the next method, the Scorecard Method. How this works is you find the average pre-money valuation of pre-revenue startups. Again, similar to the last method. You can use sources such as Crunchbase, AngelList, or whatever you think is a representative valuation for similar startups. Then you determine the individual weighted averages, as we'll show in the next slide. And lastly, you multiply that resulting factor by the average valuation. So, if you had a factor of 110% or 1.1 and a representative startup population of, say, 5 million, that would result in a 5.5 million valuation for the company you're looking at. If you had a 0.8 factor at a 2 million valuation for compared startups, that would result in a 1.6 million valuation for the current company. Here are the areas, as well as the maximum percentage weighting that gets assigned for each area. As you can see, strength of the management team is the most important, and then it goes down from there. This is one of the advantages over the Berkus method in that it weighs areas differently, and you can adjust these based on your own preferences and experience. Bill Payne and David S. Rose, author of the book Angel Investing, find this method the most useful for angels. In fact, it's so popular with Bill that sometimes it's referred to as the Bill Payne valuation method. Let's show a very quick example of the Scorecard method in action. Here's all the areas that we showed previously. Let's assume you're looking at a startup and you determine that compared to a comparison group, it has a very strong management team, so you give it 125%, a huge potential market opportunity, 150%, but then some of the other areas might be lacking. Product technology is a little below average, marketing sales channels, Perhaps you see the need for a lot of additional investment in the future and you might get diluted, and then maybe the customer feedback hasn't been too great so far. So those all get below average. Basically what you do is you take the maximum column, multiply it by your target assessment column, and you'll get a weighted factor. Lastly, sum up all of that column of the weighted factor and you get your total result of 113.5%. In this case, you think this startup is better than the comparison group of startups. Lastly, you multiply that factor by the valuation of the comparison startups. So if the comparison group had a 5 million average valuation, that would result in a 5.67 million valuation for this business in question. Pros and cons of the scorecard method. As we mentioned, it covers more areas than the Berkus method, and it weighs each of those areas differently, though it's still easy and straightforward to apply. And it's the method of choice by many angels, such as David Rose, Bill Payne, and others. However, some potential downsides. It requires skill again to know how much credit goes to each area. It ignores some areas that some of the more detailed methods cover, as we'll discuss next. And it's still dependent on choosing that appropriate benchmark startup valuation to set that maximum value in the comparison group from the start. The third method is the risk factor summation method. This method looks at a list of 12 risks that a startup must manage, and then you rank them from -2 to be unfavorable to a +2 for favorable. So you start with a pre-money valuation of pre-revenue companies that are similar in the region, and then you adjust based on those 12 risks. The monetary value that you adjust is you give it a $250,000 adjustment for each plus or minus one. So a +1 corresponds to plus $250K, while a -1 corresponds to minus $250K. In a similar way, if it's plus or minus 2, it corresponds to plus or minus $500,000, and a 0 is neutral. So one easy way of doing this is just summing up all the 1s and 2s at the end, and then multiplying that by $250,000 at the end, and adjusting the baseline valuation by that number. So, an example, if you ended with a net sum of +2, that's a $500K adjustment to the valuation. So if the average startups that you were comparing with had a 3 million valuation, this startup may be worth 3.5. Here are the 12 areas that cover everything from management risk as well as sales, technology, litigation, and more. If you assessed all of these categories and came up with the results in the example column, that results in a net of +2. Thus, overall, you would add that $500K adjustment to the valuation as discussed. Pros and cons of this method. Pros are that it does consider a lot of areas, and many that the Berkus and the scorecard method overlook. However, some of the downsides. Again, similar to Berkus, it weighs all areas as being equally important, where that may not be true. It also only looks at what could go wrong for a startup, the risks. This is kind of a glass half empty view of the world, and it doesn't look at what could go right and the huge potential upside opportunity. In addition, it still requires that skill and know-how to put how much credit goes to each area, and as with all the methods so far, it's still dependent on those initial assumptions of what startups you compare it with. Method number 4 is the venture capital method. This method starts with the end, i.e. a potential exit, in mind. So, the steps to the venture capital method? First, you estimate something called the terminal value. That's basically the exit value in a harvest year. Look for similar startups that have had M&As and recent milestones and what their valuations are. Then, you estimate your required or expected return on investment as an exit multiple. You can use our online calculator under the resources section of CrowdWise to help estimate this. For example, you might get a 20x return is necessary to meet your investment objectives, or a 30x return, or anything in between. Then, calculate the post-money valuation knowing those two numbers, which is simply the terminal value divided by the exit multiple, and then calculate the pre-money valuation by subtracting the round size from the post-money valuation. Lastly, you should account for dilution. Assuming if you're investing very early on, perhaps you assume a 50% dilution. So you multiply the dilution amount times the pre-money in the previous step, and that will give you the final pre-money valuation. Downside of this approach is that it doesn't consider aspects of the business, such as team, traction, etc. It's really only looking at your required or expected rate of return and an assumed terminal value many years out. Because of this, I don't often like using this method, but some angels do prefer to use it. But again, that's a matter of preference, so other people do prefer to use it. Let's go through a quick example. First, terminal value. Let's assume you're looking at a startup and you see many other similar startups in similar industries have exits around $50 million. Next, return on investment. You determine after using our calculators that your required return on each successful investment has to be a 20x multiple in order to make your investment goals. Next, calculate the post-money valuation. That's simply terminal value divided by that exit multiple. So 50 million divided by 20 is a 2.5 million post-money valuation today. Next, pre-money valuation is simply the current round size subtracted from the post-money valuation. So if they were raising 500,000 in the current round, it'd be 2.5 million minus that half million gives a 2 million pre. And last but not least, dilution. Assuming 50% dilution, that would be 2 million times 50% is a 1 million pre-money valuation. This is basically saying that if you assume this company is going to have a certain exit in the future, it would require at least a 1 million pre-money valuation or lower in order for you to invest today. So, pros and cons of the VC method. It's useful for calculating required or expected valuations for pre-revenue businesses. However, some downsides, as we mentioned, other than really estimating that terminal value, it doesn't look at aspects of this business, such as the team, the traction, the tech, etc. And it's so dependent on choosing that accurate terminal value that everything else depends on it. For these reasons, it's not one of my favorites, but again, it's a matter of preference for each investor, so try it out and see what works best for you. Now, we're going to move into post-revenue valuation methods. These are a little less relevant for crowdfunding and very small angel investors, but it's important to understand them, as you'll hear them discussed in the industry. First is the discounted cash flow or DCF method. Think back to those charts that we showed with Peter Thiel and how all the future cash flows of a tech company come many years out. What the discounted cash flow method looks to do is take the present value of all those future cash flows and discount it using a certain interest or discount rate to the present day. So there's two simple steps to this. You predict the annual cash flows in the future, for example, 5 years or 10 years out, and then you just discount those cash flows to the present value. Sounds pretty easy. The hard part is in accurately predicting what those cash flows are going to be. Because of this, especially for early stage businesses, at best it's an approximation, but at worst you're going to be way off in one direction or the other. Because of this, it's most applicable for mature businesses with reasonable growth rates that can be extrapolated into the future. The net present value formula is given as shown here. It's the summation of the cash flow in a given year T divided by 1 plus the interest rate raised to that year T. So pros and cons of this method. Pros, you can calculate the present value of a business based on future cash flows pretty accurately. Cons, going back to my professor, it's subject to that garbage in, garbage out. While it's a formula that will give you an exact number, the accuracy of that number is extremely dependent on how accurately you predicted those future cash flows. Thus, it can only be as accurate as those cash flows that you assume. And because no one can predict the future, it's highly speculative beyond a few years out. Because of that, it's most applicable to more mature businesses. The next method is comparable method, or comps. It involves looking at similar businesses in an industry or region and what they have raised money at as a multiple of certain KPIs, key performance indicators. Typically that's revenue or earnings, or perhaps something like daily or monthly active users. The steps include select businesses from the same niche or industry, identify your KPIs, for example, maybe it's monthly active users or annual revenue. Then look at recent M&A data for the industry, for example from Crunchbase, and get some valuations from some of those sample businesses. You also want to get the KPI for those businesses. So for example, if Twitter raised $10 million, figure out how many monthly active users Twitter had at the time of raising that amount of money, and then you can use this to help approximate your own company. Next, you estimate what that KPI is for the target startup in question, and you adjust by the multiple. For example, if the market average is, say, a 5x revenue multiple on a certain type of startup, and the startup you're looking at is currently at $500K in annual revenue, then you would take $500K times 5, and that would give you a $2.5 million valuation for your current startup. Downside of this approach is it again relies on this startup having similar outcomes to those other businesses in question. If they have a different business model or something else that's upsetting or disrupting the industry, you need to account for this in what those metrics are. So you're probably wondering, what are some example back-of-the-envelope revenue multiples to be aware of? Well, let's look at a few now. For public companies, this is pretty easy to calculate because it's so liquid, which is basically the enterprise value through the market cap divided by the sales. So Amazon right now, as of late 2019, is trading at about 3.5x revenues, or 25% gross margin, whereas Apple is 4x revenues, but notice they have a higher gross margin, around 40%. This shows that while revenue multiples is one important aspect to consider, profitability also comes into play in the question. Facebook is trading even higher at 7.5x current revenues. And assuming you had decided to look at a different metric, such as daily active users, Facebook had 1.6 billion daily active users in June 2019. So that would have corresponded to about a $320 per daily active user ratio. And that's what the market basically values each daily active user at. And to round out some of these public examples, Uber is currently trading at 5.1x revenues. Now, typically startups may trade at 2x, 5x, even up to 8x annual revenues on average. However, you got to remember that profits, as we mentioned, are part of the equation. So if a business has 5% profits versus another business with 20% profits, all else being equal, the more highly profitable business will be trading at a higher annual revenue multiple. Now, SaaS startups, because they're very popular with investors and have lower capital requirements, may be even trading at higher multiples, such as 8x to 15x revenues. This is because, typically, it's less money and capital to scale a SaaS startup versus something that might be a hardware business. Hot startups in areas may trade at even 50x plus multiples. For example, Microsoft invested in Facebook at 100x revenues. But their reason for doing that, they claim, was that it was a strategic investment. They thought that they could add some value or gain value in other ways throughout that investment. A great reference for looking at dozens of different tech startup multiples, check out this link on Quora. But remember, there's other pre-revenue metrics. You can use number of users, whatever you think the KPI is for your given startup. So, pros and cons of the comps method. Pros, it's based on the market value of real startups, and you scale it for the different KPIs. Thus, it doesn't rely on founder projections. You're looking at real market data and doing your own calculations. And it's a quick back-of-the-envelope approximation if you're intimately familiar with a given type of startup and what their multiples are. Cons of this approach, first, it assumes that your startup is going to have a similar outcome to the comparison startups. So if they're very different in terms of business model or something else, you need to account for that. Also, the choice of KPI can greatly impact your results. Using monthly active users might give you one valuation, but using a revenue approach might give you something else, while earnings and profits gives you still a third. Because of this, it's important to know what the most important KPI is for your industry or use a combination. And lastly, it ignores the talent of the team in question and other differentiators. You're basically just looking at hard numbers and assuming it's going to be similar to outcomes that have occurred in the past. Because of this, you need to think of how that actually should be adjusted if the team is, for example, phenomenal or less than average. Last but not least, we're going to talk about the first Chicago method. Now, this is the most detailed method we're going to be covering today, but you'll see why. It considers three different types of outcomes: a best case, an average outcome, and a worst case. And while this is the standard first Chicago method, you can actually adapt this to have as many different types of outcomes as you like. What you do is you take the probability of a certain valuation for the best case, and then add that to the probability times the valuation in the second case, and add that to the third case. And together, that results in your final valuation. You're basically calculating the expected value outcome based on different probabilities. So I like to think that it's a combination of both the DCF method and the comps method, since it uses both terminal values but also cash flows in the future. It estimates this range of outcomes, as we mentioned, from best, average to worst case, and you calculate the present value of each of those with an associated probability, as we mentioned. So the final valuation is just the sum of the three different types of outcomes, where P is the probability of each outcome and V is the valuation. You're then getting the present value of both the terminal value and the cash flows for each outcome. For example, Let's assume a best case scenario, you think that a company has a 20 million exit potential, but it's a small chance, only 10%. On average, you think there's a huge possibility of a 5 million exit at a 60% chance, and then of course there's a chance of failing, which you estimate to be about a 3 million outcome and a 30% chance of happening. To calculate the overall valuation of what that would be worth today with those different outcomes, you would just multiply each probability times each valuation, sum them together, and you get 5.9 million. Thus, you can see one of the advantages of the first Chicago method is that it lets you take some of these extreme outlier probabilities into account in the valuation. You're probably wondering what the formula is, so we'll show it here, but don't get overwhelmed. Basically, as we mentioned in words, the valuation at each outcome, I, which is the best, the average, or the worst case, is going to be equal to the terminal value divided by basically a discount factor, 1 plus the discount rate raised to the t number of years, plus the summation of all those cash flows, which is again discounted to the present valuation. And then once you have that valuation number for each the best, the average, and the worst case outcome, you multiply that by the probability of each of those outcomes and sum them together to get the final enterprise value. What are the pros and cons? Well, as you can tell from just looking at it, it's extremely detailed and thorough. It considers many different outcomes, looking at both cash flows, terminal values, as well as different probabilities of good and bad outcomes. Because of this, it allows you to account for those black swans, according to Taleb, which are extremely unlikely but have potentially huge impacts in either a positive or a negative direction. Cons, again, while this is a very fancy formula, garbage in, garbage out. It depends on your inputs and the quality of those assumptions going in. It's also extremely complex and time-intensive, so even for sophisticated angels, it may be overkill. It requires intimate knowledge and details of the business in question and predicting what that looks like in the future, and because of all this, it's not applicable at all for pre-revenue startups. So, you're probably wondering at this point, this is all great, but what's the best method to use? Just show me the formula and I'll go and use it. Well, the answer is that for angels and crowdfunding investors, it depends. You want to keep it simple, at least to start, before trying some of the more complex and intensive methods. You probably want to use a combination of the methods, since they often result in different valuation outcomes, and then you can compare to see where the differences are. Scorecard Method is one of the most popular among reputable angels, such as David Rose and Bill Payne, as we mentioned. And because of this, we recommend combining several of the number 1 through 4 pre-revenue early stage methods. But remember, it comes down to a lot of different things, such as investor preference, the size of the check that you're writing, the stage of the business, and what your reasons are for investing. If you're investing because you want to support a cool company and don't care about the financial returns, then you don't even need to waste any time at all in valuation. If you're investing purely to get financial gains, then valuation becomes more important. Also, the type of offering. Is it being offered on a crowdfunding portal where the valuation is already predetermined, or are you direct investing as an angel investor and do you have to negotiate with a founder? All of these things will determine which valuation methods you may choose to use. So when you're combining them, I like to use something called the football field approach for visualizing the valuations. As we mentioned, it's best to use multiple methods and then average them together to get a better idea of the estimated valuation. Consider conservative as well as aggressive estimations in doing your valuations so that you get ranges with a minimum, an average, or median, and a max. Let's assume you decided to use 3 methods, Berkus, Scorecard, and Risk Factor, and you came up with valuation ranges as you showed here. Plot the valuation on the y-axis and put each of the different valuation methods on the x-axis. Now, you can compare this to what's being offered on the crowdfunding portal. Let's assume some offering was going for a 3 million valuation. You can draw that 3 million line and see that, in general, it lines up very well with your estimated valuations. It falls within the range of 2 to the 3 of yours, although slightly on the higher range, and it is a little outside of the range of the Berkus method, but where the difference is so small, that isn't something I would worry about here. Let's assume the founder, though, was a little more aggressive and asking a 5 million valuation. This is now falling almost 2x outside of what all your valuation estimates were. So you have to ask, is this unreasonable, or are you missing something in your estimations? This begs the question, what if valuation is way off from what you get compared to what the founders are asking? It's either one of two things. Either the founder's wrong and they have unrealistic assumptions or expectations, maybe they got some bad advice from some other founders or investors, or you are wrong. You're perhaps missing a key piece of information that other investors value, and finding where these disconnects are in your own valuation skills will help you become a better investor in the future. Just remember, there's also many other valuation methods. It's often a matter of investor preference. We aren't even mentioning methods such as the cost to duplicate method, valuing based on human capital, book value or asset-based method, and many others that we don't think are as applicable to early-stage startups. The takeaway here is that you will only improve your own valuation skills over time if you practice and if you make use of the feedback when it's offered to you. On crowdfunding portals, let's talk about those valuations and how that works. Most Reg CF offerings today are early stage, so it's going to be pre-Series A, probably less than a 20 million valuation, and even less than a 10 million valuation in the majority of circumstances. However, you'll also see some Reg A offerings on some of these funding portals, and those you may see valuations of up to 50 million, even 200 million and above I've seen on some offerings. So crowdfunding portals may determine the valuation with the issuer, that is the startup, if they do their own deal curation and negotiation, or on certain portals, it may just be the founder who selects the valuation, posts it, and lets the crowd decide if it's fair. Now, obviously, the founder needs to make sure they select a valuation that will be attractive in the eyes of an investor. Otherwise, they won't hit their minimum. The pros of investing through crowdfunding is that first, the valuation is already being determined by either an experienced team that sees hundreds of startups, or you're seeing whether the crowd overall thinks that the founder's selected valuation is fair. Second, because of this, crowdfunding investors don't have to spend time negotiating and justifying valuations. This is very different from angels and venture capitalists. However, the other side of that coin is that there is no negotiating. If you don't like what's posted on the funding portal, you can't try and renegotiate that yourself. So you either have to invest at the higher value or you don't invest at all. Let's recap what we've covered today with the top 7 valuation methods. First, we've mentioned that practice makes perfect. There is no magic formula that will always result in a single truth. Remember that garbage in, garbage out. There is no substitute for experience. Second, keep it simple, especially when starting out. You can start with some of the simple methods before moving on to the advanced methods and see which ones work best for you and for the startups that you're looking at. It depends on a lot of things, remember, such as personal investor preferences, the check size that you're writing, and the stage of the startups you're investing in. And use multiple methods. Use that football field approach to see if your methods are giving relatively similar valuations, and then compare that with what the founders are offering. Use this to get feedback on your valuation skills. You'll probably find startups, more often than not, that are raising at different valuations than what you thought they were worth. Thus, doing this in advance and then figuring out why that difference or that gap exists in valuation will help make your valuation skills better as an investor in the future. Next lesson, we're going to look at a real-world case study evaluation. We're going to apply some of these methods to a recent crowdfunding business. We'll run through the various valuation methods and show you how it works in practice. You're part of the Level 3 Advanced Investor courses for screening deals, due diligence, and valuation right now. If you haven't already, sign up at academy.crowdwise.org for the best learning experience and for all the supplemental materials. Thank you. Make sure you follow us on all our social, and we'll see you back here for the next lesson where we do an actual valuation exercise.